Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillah, Allahumma salli ala Sayyidina Muhammad wa ala alihi wa sahbihi ajma'in amma ba'd. Hello everyone. So today we are going to learn about dividend for common stocks. We're going to continue what we have left in our lecture in week 6. Yeah. And hopefully this will be useful for your learning materials to understand better about the stocks and its dividend. So allow me to share my screen. So last week we stopped at discussing common stock dividend. So we will start discussing about the common stock dividend. So when we say dividend, yeah, it is a share of the company's profit, which is distributed to stakeholders or stockholders. I'm sorry, to stockholders. Usually, the company's profit goes like this. So they have the revenue, yeah, minus all the expenses, yeah, and then you get the profit before tax, then you minus it or you deduct it with tax in order to get the net profit. And the net profit usually is divided into two. The first one is the net profit goes to stockholder as dividend, and the second one, it goes as what we call the return earnings. So return earnings. So these return earnings are part of the net profit which are not distributed as dividend. Usually this share of return earnings are used for the next year operations, yeah, for they usually be used for expanding the business. They going to use it for making some investment, maybe expanding the factory. They use it for investing in technologies and etc. So not all part of the net profit goes for dividends, but some of them are returned or retained as return earnings. Okay. Okay, let's continue. Dividend income is one of the two basic sources of return for investors. So dividend represent return of part of the profit of the company to the owner, to the stockholders. And another part or the other part of this net profit goes to return earning, as we explained you before. Dividend income is more predictable than capital gains, yeah, because capital gains not 100% give you one positive gain, but also losses. So imagine if you have a stock, and then at the end of the period, you sell it at lower price than you bought, then you will face losses. Yeah, so it is much more easier. Dividend is much more easier to predict. It is much more easier to calculate because this is not like the stock price when it fluctuates and it is volatile in the market. Dividend is the announcement of the company to share some of its net profit to the stockholders. And then we will learn about some technical things, yeah, about dividends in the next slides. The current tax law put dividends on the same plane or as capital gains. Now they are taxed at the same rate. So whether you have a capital gains or whether you receive dividends, all of them are taxed. Yeah, all of them are taxed based or depending on the regulation of that country. In the next slides, we're going to learn about the dividend decisions, type of dividends, and dividend reinvestment plans. Okay. So we're going to learn about dividend decision. Yeah. So a firm board of director evaluate the firm's operating result and financial condition to determine whether dividends should be paid out and in what amount. Basically, in the end of each financial year, the board of directors, they will dividend to the stockholders and in what form. Even in cash, yeah. So like for instance, I have shares in Telkom, and they announced to the public that he is going to give dividend. Yeah, let's say 100 rupiah for each share, or let's say 50 rupiah for each share. Yeah, the decision about the amount of cash given as dividend will be discussed by board of directors, and they're going to decide also about the timing. Yeah, the timing to give dividend, which will be discussed in the next slides. We have what we call earning per share. Earning per share is the amount of annual earnings available to common stockholders stated on a per share basis. How much you earn for each share you have in that company. This is what we call EPS, or earning per share. This is very important variable in investment decision making, because for some investors, they expect, yeah, to receive a certain amount of dividends. Yeah, because some of the investors, they like to invest in companies which give dividends. Yeah, as I have a friend in Surabaya. Yeah, he has a lot of shares in Telkom, the LKM. Yeah, and he told me that each year he received about 60 million dividend from Telkom. And my friend, and this friend of mine, he is focusing on receiving dividend. Yeah, so he's not going to sell, or he's not focusing on getting a positive capital gains, but he always try to focus on receiving dividends instead of capital gains. All right, so this is earning per share. Earning per share indicates the value that you get, the dividend that you will receive for owning the company. These are the some consideration, yeah, some consideration that the corporate must consider. First is the growth prospect. How much does the firm need of their earning to invest and finance future growth? As I explained you before, that the net profit of the company will not be distributed only for dividend, but also it will be retained, will be saved by the company for future development. That's why the company earning. That's why the company will need to consider how much it will be distributed as dividend. Right. Next, the cash position. Next to dividend will be the company will also try to consider how much cash position, in other words, how much liquidity they need to make sure that they are not going to have cash shortfall. The they're going to make sure that the next year daily operation will be covered up by available cash in the company. Then another consideration is that loan agreement. Is the firm legally limited in the amount of dividend it can pay? Because when you have many liabilities to pay, you need to consider whether you prioritize paying your liabilities rather than sharing your profit as dividend. It is much better for companies which have because nowadays it's not good for the company. Well, I think the company needs to prioritize paying off its liability rather than giving dividends. Uh, giving dividends. So they need to evaluate, they need to be thinking about dividend of in the firm, reinvesting them at a favorable rate of return to achieve the growth and profit. So when they decide some share of the net profit will be, will be allocated for retained earnings, they need to justify. They need to justify to the public, to the stakeholders, why they choose to make this kind of proposal for the replacement. Let's say that 100% of net profit they will be distributed as dividend, let's say 60% will be distributed as dividend and 40% will be distributed as return earnings. They need to convince the market, they need to convince the investors, the stockholders, why they return 40% of the net profit. Because we have different what we call it, we have different goals. Investors, they want to receive as much profit as they could, while the managers, they want to expand the business. So kind of in management we call this agency problem, where different stakeholders, they have their different issues, different needs, different goals, different obligations, which make this decision making in the company more complicated. So when they decide to allocate 40% of the net profit for return earnings, they have to justify the allocation of 40% to the public, to the investor. So they need to make a very good plan. What are they going to use this 40% for? Are they going to use it for technological development? Are they going to open new branches in other countries, for example? Are they going to, let's say, open new factory, entering new market, etc.? Okay. What are the dividend expectation of its shareholders? This is also an important point. So justification is very much needed. During the process of deciding how much dividend will be given to stockholders. All right, so next we are going to learn about some important dates. So usually there are important dates during decision of dividend. So once a dividend is declared by board of director, or once dividends is agreed by board of directors, the firm must indicate certain dates associated with that dividend. The first one is date of record, date on which the investor must be registered shareholder of the firm, holder of record to receive a dividend. So let's go to the next slide. So yeah. So let's say that the company, they declare that they will be given some percentage of the net profit as dividend to the stockholder. Let's say they do this in 27th of June. This is the declaration of date. Well, the date of record, yeah, this is the date of record, which means that in this date, they are going to register all names of stockholders, the bank account of stockholders. Yeah, because what? Because you know, like stocks, they are traded daily. Yeah, they are traded daily. So the stock is traded daily, the ownership of that share is changing over time. Yeah, it's changing over time. So let's say that today some percentage of share is owned by this man. Next week it is traded, so the ownership changed to this man, and this process will continue. Yeah, and so that's why we need the date of record. Yeah, usually this date the company will try to record all the names of the shareholders. All right. So next, we have the payment date. The payment date or the payable date is the actual date on which the company will mail dividend check to holders of record. Generally, follow the date of record by a week or two. So this is the payment date. In this date, the company will distribute all dividends to the stockholders through checks. I don't know. I think today's in our nowadays, yeah, the system will just transfer the dividend to your bank account. Yeah, so I think this is I don't know. Maybe we have a different technology or different regulation there, but if I'm not mistaken, the dividend will be transferred directly to our bank account nowadays. All right, so this the 30th of July is the payment date. Means that the company will distribute the dividends to stockholders. Ex-dividend date indicate whether you were an official shareholder and therefore eligible to receive the declared dividend. Stock will sell without the dividend for 3 business days up to and including the date of record because of time needed to make bookkeeping in entries. So usually, yeah, when a company have declared that they will distribute dividends, stockholders tend to hold their stock. Yeah, they try to hold their stock in order to receive dividend because this is another profit for them, right? And then the company will then try to record all names, all bank account of stockholders. Yeah, and they will do it in this ex-dividend date and date of record. And during this period, they will try to lock the name of the stockholder who will receive dividends. Yeah. So please, guys, if you are an investor and you hear that such company will distribute dividends, don't sell it. Just hold it for a little bit longer until you receive the dividend, and then you may try to sell it. Right. Next, several types of there are two main types of dividends. First one is cash dividend. The dividend is paid out in the form of cash. I have a share of Telkom, TLKM. Last time, if I'm not mistaken, we try to distribute rupiah or 55 rupiah for each share. This is the dividend paid out in the form of cash. And there's also dividend paid out in the form of stock. We call this stock dividend. This is rarely happen. Yeah. So the dividends may be paid out in the form such as stock spin-off or perhaps samples of the company's product. Yeah. So these are another kind of dividend paid to the shareholder, which is not given in the form of cash. Cash dividend is most common, most generally practiced out by the company. It tends to increase over time as companies earnings grow. So usually, yeah, the companies will try to make the strategy of having an increasing trend of dividend. So let's say that if this year Telkom pays you 55 rupiah for each share, next year you will find that the dividend paid to the stockholder will increase. Let's say they will give you 59 next year, and they will give you 60 rupiah next year, or they will give you 80 rupiah the next 2 years. Yeah, usually the company will try to make its dividend having an increasing trend. Yeah, so this is kind of a brand for them. This is kind of a pride for them. Yeah, to have a very good growth of dividend. And if the company can do this, mean that the company is doing well. Yeah, it experiencing growth. Yeah, and the earnings of the company is also growing. Yeah. That's why the company will always try to have this kind of trend, an increasing trend. Yeah, and they try to preserve it because this is what makes the company looks out. All right. All right. Okay. So next slide. The cash dividend, dividend yield. There is a ratio that you can use in order to evaluate, yeah, dividend. We call this dividend yield. Measure dividend on a relative percentage basis rather than an absolute dollar basis. Okay, so the dividend yield, the annual dividend received per share divided by current market price of the stock. Yeah, so dividend yield, yeah, it measure the relative percentage basis. So it measure dividend on a relative percentage basis rather than on an absolute dollar basis. So actually this ratio is useful if you want to compare it through years. You see that the number of yield is increasing, meaning that they have very good performance. Yeah. Then dividend payout ratio measures the percentage of earnings that a firm pays in dividends. Ratios are beneficial for you. Try to compare it to years. Try to compare it through different companies. Yeah, I think this method will give you a way of comparing between the performance of multi-years performance or the performance of several companies. Stock dividend. So dividend in the form of stock. A stock dividend means that the firm pays its dividend by distributing additional share of stock. This is the example. A 10% stock dividend would mean that you would receive one new share of stock for each 10 share you currently own. So let's say that they are giving a 10% of stock dividends. So what does it mean? Mean that for each 10 share that you have, you're going to receive one new share. Yeah, this is if the dividend in the cash in the form of stock. Stock dividends usually stock dividends, unlike cash dividend, are not taxed until you actually sell the stock. So there is no tax, yeah, when the dividend is distributed as the form of stock, in the form of stock. Rather, they will tax you when you sell that stock. Okay. Dividend reinvestment plan. So there is another alternative which we call DRIP, a corporate sponsor program where shareholders can have their cash dividend automatically reinvest into additional share of the company stock. So instead of giving you cash, this cash, or instead of giving you the cash directly to your bank account, transfer to your bank account, this cash is collected to be invested for the same share. Or in other words, you are going to reinvest the dividend yield that you have to buy the stock of the company. Yeah. So you're not going to receive the dividend as cash in your bank account, but the dividend will be reinvested. It will be reinvested, so you will receive new share. New share, of course, based on the market value of that share. So over 1,000 companies offer DRIPs, convenience and inexpensive way to accumulate capital. Yeah, so the company receive new capital by adding the additional outstanding stock, or by adding the number of additional outstanding stock, by adding the number of outstanding stock, I mean. Yeah, usually free of brokerage commissions, so you don't need to, the companies will not need to pay the brokerage fee, yeah, because they can directly do it in their corporation. Most plans allow partial participation. Similarly, investment programs are offered by mutual fund and some brokerage house, such as Bank America and Fidelity. So, you know, in some mutual fund in the US, they also have this kind of option. Rather than giving you a profit in the form of cash, they collected this profit and bought another securities, another stocks or bonds or etc. So reinvested dividends are treated as taxable income in the year they are received, just as though they had been received as cash. So the reinvested dividends, yeah, are treated as taxable income in the year they are received. So this is the treatment of reinvested dividends in the US, which is treated as taxable income in the year they are received. All right. This is the what we call this a comparison between if you are taking the dividend in the form of cash, or you reinvested 100% of the cash to buy another stocks, to buy another shares. Yeah. So let's say here you buy 100 share of stock at 25. So you have a total investment of 2,500. The stock currently pays $1 a share in annual dividends. Yeah, so the the dividend for each share is 1, and the price of the stock increases at 8% per year. Dividends grow at 5% per year. All right, so this is the calculation. So let's say here that this is what you have, yeah. This is what you have after some period. Let's say this is after 5 periods. So you receive cash dividend at $552 because the dividend grows at 5% each year. So the cash dividend you receive is $552. Wait a second. All right, so I'm sorry, there was technical issue. Okay, let me continue. So this is the total cash dividend that you will receive if you receive in cash, and this is the value of the this is the value of the stock that you will receive in the that you will have in the end of the 5 year. So this is the dividend is growing, yeah, and the stock price is growing at 8% annually. But if we compare here, if we reinvest all the dividend that we got annually, we reinvest it, we bought it another share, the value is very amazing actually. It will end up to $20,000, $20.5 thousand. While if you receive it in cash and you don't reinvest it, you will receive only 11.6 plus 3.3. Let's say you will receive only 50, yeah, $15,000. Yeah. Well, if you reinvest your dividends, 100% reinvest your dividends, you're going to end up after 20 years of period with $20,000 in value if you have 100 share. Yeah, this is an amazing. This is an amazing, yeah, an amazing growth. Okay. All right. So next we are going to learn about the use and types of common stock. Yeah. So what are the types of common stock? Because in the global market there are many kind of stocks, many types, and the uses are varied. Yeah. So we're going to learn about different types and uses of common stock. The first one, this is the most common, the most preferable, yeah, the most known, which is blue chip stock. So what does it mean, blue chip stock? Blue chip means stock issued by large, well-established firms with long track record of earning profits and paying dividends. Yeah, so this is like the big guys, you know, like the leaders of the market. This is the leaders in their industries. Yeah, not all blue chips are alike. Some provide consistently high dividend yield. For instance, AT&T, Chevron, McDonald's, Johnson & Johnson, Pfizer. Other are more growth oriented. So these companies, example of the blue chip companies, blue chip stocks which give you high dividend yield, but more they focus on increasing the value of the share. Yeah, Nike, Home Depot, Walgreens, United Parcel Service, and etc. So the blue chip stocks are less risky than most stocks, appeal to investors who want to earn higher returns than bonds typically offer without taking a great deal of risk, because they are already well known. The companies is always having a good performance. Yeah, many investors are taking good perception of these blue chip stocks. They have less risk exposure. That's why if you want to invest in, in investment alternative which give you a good profit, less risk, yeah, you can try invest in blue chip stocks. All right. The next one is income stock. Income stocks are stock with a long history of regularly paying higher than average dividends. So these companies, they focus on paying dividends to their stockholders. Yeah. So it is very ideal alternative of investment for those who want to invest in relatively safe and high level of current income. Yeah, and dividend tend to increase regularly on time. So they try to preserve the increasing trend of giving dividends. Some companies pay high dividends because they offer limited growth potential. Yeah, subject to a fair amount of interest rate risk. So you have a very great exposure of interest rate risks, because when the interest rate is increasing, yeah, it is more attractive to invest in 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 securities which pays you interest rate. All right. So there are some example. Many public utilities such as American Electric, Power and Duke Energy, and then Conagra Foods, General Mills, and Altria Groups. These are stocks which focus on income, or which focus on providing dividends for its stockholder. And then there is growth stock. Yeah. Growth stock, they are stocks issued by companies which experiencing rapid growth in revenues and earnings. So have sustained earning growth well above the general market. Typically pay little or no dividends. So you only focus on capital gain here. Yeah, so you only focus on price appreciation here, price increase. Yeah, may include blue chip stocks as well as speculative stocks. Yeah, appeal to investor looking for attractive capital gains rather than dividends, but they have to be willing to bear more risk, to expose more risk. Yeah, riskier investment because price may fall if earning growth cannot be maintained, particularly in a down market. So the fluctuation, yeah, need to be considered. Some example of growth stock are Amazon, Starbucks, and these are example of growth stock. Tech stocks. So tech stocks are stocks of companies that are usually focused on technology. Yeah, stock representing the technology sector of the market. Yeah, includes company which produce computers, semiconductors, data storage device, software, as well as those that provide internet service, networking equipment, and etc. Range from speculative stock of small companies to stock of large company that are growth oriented some of which are legitimate blue chips. For instance, companies such as Apple, Samsung, companies such as this one. These are the example: Apple, Google, AMD, Nvidia, Marvel Technology, Facebook. Yeah, these are the example of tech stocks. Yeah, they offer potentially high returns, but also risk and volatility. So you guys need to be very careful. You need to make a very good measurement, very good calculation before investing in tech stocks. All right. Next, speculative stocks. Speculative stocks. Speculative stock is stock representing that speculative stock that offer potential for substantial price appreciation, but that lack sustained record of success. So this kind of stocks, speculative stocks, they can be very high in price level, but also can be very low in price level. The fluctuation, the price movement is very real. It's very it bears a lot of risk in this kind of stocks. Attractive, particularly when the market is bullish. So it is attractive when the market is having a good trend. Bullish means that they are expecting a good trend, good economic future or good economic prospects, offer attractive growth prospect with the chance to hit it big in the market. So if you want to have a very high return, you may consider investing in speculative stocks, but please be careful that not 100% will give you a price appreciation. It could also give you a price depreciation, a price decrease, a price fall. That's why, because it gives you very high or very low price change, the volatility is very big. The risk is very big. But once you hit the target, you got it to hit it big. You will hit it big. If you can choose the right stocks at the right time and sell it at the right time, you may be able to receive a lot of profit. But again, this speculative stocks is very high in risk. These are the example in the US market. We can these are stocks that can pay you a lot of profit, or that can give you a lot of profit, but also can give you a lot of loss. All right, next is the cyclical stocks. What does it mean, the cyclical stock? Stock issued by companies whose earnings are closely linked to the overall company. So when the overall economy, when the overall economy is having a good trend, this cyclical stock is usually follow the performance of the economy. So when they are having a good trend, they tend to have a price increase. But when the economy is having a downfall, this stock also is having a decreasing trend, right? These are the example, So Alcoa, Caterpillar, these are the example of stocks that follow the performance of the economy, And if you can predict about what is going on in the economy, you may try to consider investing in cyclical stocks because you know what's going on, what will happen in the economy, what's the future prospect of the economy. Yeah. Next is defensive stock. It is stocks that tend to hold their value and even do well when the economy starts to falter. So this defensive stock, yeah, is kind of the stock which not the highly depends on the performance of the economy. Yeah, this is this kind of defensive stock may remain strong despite the economy having a downturn, despite the economy starting to fall. Yeah, so this is the kind of stock that you want to invest in during economic downturn. Yeah, tend to be less susceptible to downswings in the business cycle than the average stock, commonly used by aggressive investor looking for a parking place during a slow economy. Yeah, includes stock of public utilities. So yeah, industrial and consumer good companies that produce or market staples such as beverage, food, and drugs. So these defensive stocks, usually stocks which have a focus on the industry of food and beverage, drugs, yeah, because even during economic downturn, yeah, people demand food, people demand drugs, medicine, people demand beverage, yeah. They will not, yeah, they will not survive, yeah, if they don't eat. Yeah, that's why this kind of stocks, they are very powerful, they are very good alternative during economic downturn, they are strong during economic downturn. So this is an alternative that you may consider. But usually this kind of stocks does not have a very high profit in income. Yeah, because it relates to our daily consumptions and etc. Okay, the next one is the market cap stock or market capitalization. Yeah. So in the US, the market or the stocks market can be broken into 3 segments based on its market capitalization. So the easiest way to understand the market capitalization is that number of outstanding stock, the number of outstanding stocks multiplied by the market value, the price value, the market price of that stock. So if you say that Apple, yeah, Apple has 300 million of stocks, yeah, of share, and each share is priced, let's say, $1.5. You just multiply the number of outstanding stock in the market multiplied by the market price in order to get the market capitalization. So this is the easiest way to understand market capitalization. And stock is divided into 3 levels of market capitalization. There are large cap stocks. So it is the stock of large company with market capitalization more than 10 billion US dollar. Yeah, few in number, but account for over 75% of the total market value of all US equities. Yeah, bigger is not necessarily better. Small cap stocks tend to earn higher returns. The example is Walmart, ExxonMobil, Apple. Yeah, these are the large cap stocks which has over than 10 billion US dollar. Mid cap stocks, they have the market capitalization between 2 until 10 billion US dollar. Actually, they tend to have a better opportunity for price appreciation rather than the big cap, yeah, but less price volatility than the small caps, right? So usually have long-term records. So example is that Wendy's, Williams Sonoma, and etc. They have also a term called baby blues, yeah, a type of mid-cap stocks that offer the same characteristic of blue chip stock except size. So they have a very good performance. Yeah, they have a very good. They pay also dividend. They have very good performance in price appreciations, in the capital gains. And the baby blues, yeah, is a blue chip, but not as big as them. Ideal for investors seeking quality long-term growth. So the examples are Logitech and American Eagle Outfitters. The small cap is stock with market capitalization less than 2 billion US dollar. It has potential for high returns, but along with a high risk exposure, usually not widely traded because of the liquidity issue. Yeah, example are, for example, Spectrum Pharmaceuticals, Shoe Carnival, and etc. Yeah, this kind of stocks usually are stock that just have IPO, just conducted IPO, the initial public offering. Let's see here, investing in foreign stocks. This is another alternative. Yeah. So the globalization of financial market is growing. US share of the world equity market dropped below 40% in 2018, compared to two-thirds in the 1970s. So during 1970s, the market investors, yeah, the share of US equity, world equity, is two-thirds. But now the US share of the world equity is only 40%. So over a long period of time, stock return in the US have been unremarkable relative to those in other markets around the world. They are definitely attractive return awaiting investor willing to venture into the foreign markets. These slides give you the idea of opportunity for investing in foreign markets. So investor in the US, in the local markets, they have to consider about the opportunity to gain profit by investing in foreign market. Yeah, they provide very nice opportunity that are worth considering. Yeah, that's why foreign investor they have to consider, yeah, investing abroad. So this is the annual average stock returns around the world. You see the here in 19 to 2017. You see that the United States is just normal, like an ordinary market. But if you try to look at Finland, South Africa, Japan, Italy, Germany, France, and Australia, and also the New Zealand, they tend to have higher annual stock returns than the US. Mean that the US investor, they need to consider about the opportunity of getting profit in the foreign capital market. So investing in foreign stock, yeah, there are several things that need to be considered. You need to know what you are doing. You need to know what market you are investing to. You need to have a big toleration in case of market risk. You need to know, yeah, that there are so many risks that you need to consider. For instance, the interest rate risk, the foreign exchange rate risk, yeah, the market risk, and etc. You need also to consider the regulations, yeah, the regulation that applies in that specific market, yeah, the language barrier, the different culture and customs, the different regulation and accounting standard, and etc. So there are many things needs to be considered before investing abroad. Yeah. But there's also an alternative. You can go abroad or invest abroad with ADRs. So ADRs is American Depository Receipt, which are dollar-denominated instruments that represent ownership interest in American depository share. So ADS is represent a certain number of share in a non-US company that have been deposited in the US bank. So ADS is kind of share for those non-US companies which have a bank account in the US. Great for investor who want to own foreign stock without the hassles to often come with them. So you're not going to receive many difficulties, because when you try to invest in other countries, you need to understand the language, the regulation. You need to be accustomed with the accounting standard, and etc. You need to deal with tax, and usually foreign tax is much higher than the local tax, and etc. ADR are bought and sold in US market, just like stock in the US company. Transactions are in the US dollar. So these are the putting global returns in perspective. So so how you calculate a global return? Yeah. So the total return in US dollar, say that this is current income, dividend, plus the capital gain or losses, plus or minus change in currency exchange rate. So you can also get it from total return in US dollar equal to return from current income and capital gains in local currency. And then you add or deduct it from the return from change in the currency exchange rate. This is the way to calculate the return in the global perspective. There's also a way to calculate the return in the global perspective by this formula, where ending value of stock in foreign currency, plus the amount dividend received in that foreign currency, divided by beginning value of stock in foreign currency, multiplied by exchange rate at the end of holding period, divided by exchange rate at the beginning of holding period. This is a way to calculate the return for the global investment or for the foreign investment. Yeah, there is an exchange rate consideration here. Yeah, so you need to be careful when you are calculating the return from abroad investment or foreign investment, when you need to consider the exchange rate elements. Right? Okay. Currency exchange rates. So a stronger US dollar has negative impact on foreign investment. A weaker US dollar has positive impact on foreign investment. Why? Let's say that I have a profit from my abroad investment, let's say 100 million rupiah, and I am a US citizen. All right. I'm a US citizen. When the price of dollar is appreciated, a stronger US dollar means that the amount of dollar that I will receive will be less. And the opposite is true. A weaker US dollar or a depreciation in the currency of US dollar, I will have more to receive, yeah, when the US dollar is depreciated. Okay, you want the value of both the foreign stock and the foreign currency to go up over your investment horizon. So when you want to invest in some country, you want your currency to be stronger, to appreciate. While if you want to receive from that foreign investment, you want the currency to be the weaker. Yeah, I will give you another story. Let's say Pak Obed is Indonesian citizen. I have an investment in Chinese stock market. Let's say I want to invest 100 million in Chinese capital market. So when, yeah, let's say when yuan is 150 rupiah, let's say, or 150 rupiah, yeah. So let's say that if the price of yuan appreciated, means that the yuan goes stronger, yeah, my investment will be less. And if yuan is depreciated and my currency is appreciated, then I will get more yuan. Yeah. So if I want to invest abroad, I'm expecting that my currency will be appreciated because I want to get more value of my investment. Yeah, that's why if you invest in other countries, you expect appreciation of rupiah and depreciation of yuan. But if you receive profit, if you receive or if you take back your money, you expect a different. You want rupiah to be depreciated. Yeah, you want rupiah to be depreciated and yuan to be appreciated because you want to get more profit in Indonesia. Right? Alternative investment strategies, investor may use common stock as a storehouse of value. So safety of investment must important, use high quality blue chip and non-speculative stock. If you, this is the strategies, yeah, different strategies. If you want to have a storehouse of value, yeah, you might go to invest in high quality blue chip and non-speculative stocks. If you want to accumulate capital, you want to have a more increase in capital, yeah, you can invest in growth stock or income stock. If you want to receive sources of income, yeah, and it is a dependable sources of income, you can focus on stock which give you dividends. Yeah. So all of us have different goals of investment, and you need to decide your investment based on your goal. If you are looking for stable income, sources of income, you might focus on investing in dividend stock. If you want to have capital gain, yeah, you want to be aggressive, you want to get a profit, higher profit, you want to receive a lot of price appreciation, you might focus on growth stock. But if you want to focus on, you know, like a storehouse of value, you're not going for capital gains or stock growth, you are not going also for the dividends, but just as a store of value. Yeah, you may focus on blue chip stocks and don't focus on non-speculative on speculative stocks, because the risk is high, even though the return is also high. Okay, so you need to evaluate what kind of goals, what kind of strategies that you need to choose. Alternative investment strategies is buy and hold. So this is a lot of amazing stories using these strategies. So you buy stock and you keep it with you until several years pass. Yeah, and through this past years, you are adding more stocks on it. Yeah, this is a very basic and very conservative investment strategy. Remember, if you invest in Apple in early 2000, and then you keep buying the stock Apple, you will have a very big price appreciation if you still have it until now. You know, you remember a friend of mine that I told you the story in the beginning of this video. He kept buying the share of Telkom when he was in 2000, early in 2000. So he kept buying the price of Telkom. Back then, he told me that the price was 300, 400 rupiah. But look at now, the price is 4,000 rupiah and something. Yeah. So this is buy and hold strategy, very basic, very old, traditional, conservative investment strategy. Current income. So if you focus on receiving income, you may buy stocks that have increasing dividend yield. Yeah. Capital gains are of secondary importance, so you focus more on getting dividends. Quality long-term growth. This is the kind of the stock which emphasize more capital gains rather than types of returns from dividends. So you focus on capital gains more on dividends. Aggressive stock management. Yeah, so this is kind of the strategy that you focus on getting as high return as possible. You're gonna focus on stocks which has a very high performance and holding it for short periods. Yeah. So you always watch the market. You always look at the informations about the movement of the price, and it's very aggressive. It's also very dangerous because you know, when you are aggressive, you might expect a higher return, but you are also exposed to higher risk. Speculation and short-term trading. This is the most dangerous one. I'm not suggesting you to invest in using the speculative and short-term trading. The sole objective is to receive capital gain. You hold it a very short time period. You hold it for a very short time period. So let's say that you invest in the morning, and if you see the price has appreciated for a certain level, you sell it in the evening. Yeah. There are many people using this speculation and short-term trading. They may also use margin trading. Yeah, they borrow the money from the company in order to buy more stocks. Yeah, because they have a very good speculation. Because they speculate that the market is going to the market is bullish. Yeah, the market is not going bearish. Yeah, and yeah, this is a kind of strategies, very dangerous, very risky. Not everyone can do this, but everyone tend to do this, speculative and short-term trading. It is not recommended for new beginners like us. Yeah, it is done by very well experienced guys, very well experienced stock traders, yeah, in the world. All right, so this is the different strategies of investment. We can study in more detail by reading the PowerPoint slides. Okay, that is for today's video. I hope that it will help you in your learning. Thank you so much. Stay healthy. Assalamualaikum warahmatullahi wabarakatuh.